One narrow strip of water just repriced every market on Earth. The Strait of Hormuz, 21 miles wide at its narrowest point, reopened to commercial shipping for less than 48 hours this week. And in that window, the S&P 500 rocketed 4.5% to an all-time high of 7,126. Oil collapsed 16%. Gold kept climbing toward $4,900 an ounce. And then, just as fast, Iran reversed course and closed it again. If you're watching this, you already sense that what happened this week isn't just news, it's a signal. The Santiago Capital Research Team, which publishes the macro Pilgrims ledger every week, walked through every data point, every policy shift, and every market reaction in real time. Their analysis maps a week that most investors will misread because the headline rally hides something underneath that almost nobody is connecting. In the next few minutes, I'll show you the economic data that contradicts the euphoria, the Fed's last words before going silent, and one asset that's been quietly winning no matter which direction this crisis goes. That asset is the part that surprised me. Let me show you why. Markets move on stories. Every investor knows that. The story of the week changes every cycle. And this week's story changed 3 times in 5 days. Here's the machine that drove it. The week opened with U.S. Central Command confirming that 13 Iranian oil tankers had been intercepted and turned back. Oil was pushing toward $100 a barrel. Think of it like a garden hose. Someone was standing on it, and the pressure was building everywhere downstream. Fuel costs, airfares, groceries, fertilizer. Then Friday, Iran's foreign minister announced the strait was open. The hose unclenched. Oil dropped more than 14% in a single session, the worst day in years. You can see it right there on the WTI crude chart, a sheer cliff on the right side. The Nasdaq extended its winning streak to 13 straight sessions, something that hasn't happened since 1992. The Dow pressed back toward 50,000, but Santiago Capital's weekly ledger frames this rally differently, because by Saturday, Iran reversed course. The strait was closed again. The hose got stepped on a second time. So the question the ledger raises is the one most people aren't asking yet. What happens to all the trades placed on Friday, when Monday opens with the strait shut? The answer involves data most analysts have been avoiding, and the numbers are uncomfortable. Nobody likes being caught off guard, and the economic data this week is the kind that catches people. Small business optimism, measured by the NFIB index, fell to 95.8. That's below its 52-year historical average for the first time since April 2025. 8 of 10 components declined. Profit trends dropped 11 points to a net negative 25%. Picture a Main Street shop owner in Wichita, Kansas. She's watching her fuel costs climb, her customers pull back, and her margins get thinner every month. That's what negative 25% feels like on a balance sheet. Industrial production fell 0.5% in March, the largest monthly drop since September 2024. Motor vehicles led the decline, down 3.7%. Capacity utilization slipped to 75.7%, which means roughly 1 in 4 factory machines in America sat idle. But notice how the pattern shifts when you look at the regional manufacturing surveys. The Empire State Index surged back into expansion territory. The Philadelphia Fed reading hit 26.7, its highest since January 2025. New orders in Philly jumped 24 points to 33. Companies were growing activity while cutting headcount, and prices paid jumped to 59.3, the highest since August. The Santiago Capital Ledger highlights this divergence because it's the kind of split that precedes something bigger. Strong orders, rising prices, shrinking payrolls. That combination has a name, and the Fed just used it in their last public remarks before going dark. I'll get to exactly what they said in a moment. Everyone watches the Fed, Fewer people listen to what they actually say in the final hours before they stop talking. This week, 2 Fed officials delivered their last public remarks before the blackout period, ahead of the April 28-29 meeting. And what they said should land differently now that you've seen the data. New York Fed President John Williams said, "The Middle East conflict is, in his words, driving significant increases in energy prices that are already lifting overall inflation. Higher fuel costs are passing through into airfares, groceries, fertilizer, and consumer products across the board." Then, on Friday, Governor Christopher Waller gave what Brent Johnson calls the clearest framing of the Fed's dual mandate dilemma. Waller projected that PCE inflation, the Fed's preferred measure, would reach 3.5% in March. The target is 2%. He said the longer the strait stays constrained, the greater the chances higher inflation gets embedded. Think of inflation like water seeping into the walls of a house. You can dry the surface, but if the leak runs long enough, the damage is structural. Waller laid out 2 paths. If the conflict resolves quickly, he stays cautious on cuts now, but opens the door later this year. If high inflation and weak hiring arrive together, he holds rates indefinitely. The Fed funds rate sits at 3.5% to 3.75%. The market expects no change at the April meeting, but the moment you realize the Fed is describing a world where they can't cut, even if the economy weakens, the next move for your portfolio gets clearer, and there are really only 2 paths from here. Markets give you 2 choices, and most weeks the honest answer is that both carry risk. Here are the 2 paths. Path 1. The ceasefire holds. A broader deal takes shape, and oil settles back below $80. In that world, inflation pressures ease. The Fed gets room to cut rates later this year. Equities keep climbing. The rally you saw this week becomes the start of a longer run. Path 2. Iran's Saturday reversal is the template. The strait opens and closes like a valve, unpredictably. Oil stays volatile between $80 and $100. Inflation stays sticky above 3%. The Fed holds rates indefinitely, and the economy slows into it. In both scenarios, there's one asset that kept climbing this entire week, and for 4 straight weeks before it. Gold closed near $4,907 an ounce. You can see it on the gold spot chart, a steady upward march that barely flinched at any headline. The Santiago capital analysis points out that gold wins in both lanes because it responds to inflation staying high and to the dollar softening simultaneously. You can position for path 1 or path 2, but in either case, the investors who navigate this well are the ones who saw the setup early, before the blackout, before the next FOMC decision, before the strait opens or closes again. So where do you get research this clear, delivered this consistently? That's what I want to show you last. I told you the investors who navigate this well are the ones who see it early. This is how they see it early. The Santiago Capital Macro Pilgrims Ledger, published every week, walks through every data release, every policy shift, every chart, and every geopolitical move, the way we just did. It connects the dots between a small business survey in March and a Fed governor's speech in April and a warship in the Persian Gulf, because those dots are already connected. Most people just don't see the thread. You've spent the last few minutes doing something most investors never do. You sat with the data. You followed the logic. You now understand why this week's rally and this week's risks are 2 sides of the same coin. The link to subscribe to the Macro Pilgrims Ledger is in the description below. Because in a market where the Strait of Hormuz can open and close in the same weekend, the cost of being late is a lot higher than the cost of being early. Subscribe to the newsletter. And if this video helped you think more clearly about your money, hit subscribe on this channel too, so you don't miss the next one.